What makes a company valuable? What makes it such that investors on the stock market are willing to pay for the company? As a shareholder, the company that you own is going to have a steady stream of income. This stream of income is pure profit attributed to you as a shareholder after deducting all expenses. This stream of income has value, and the stock market is going to assign a certain valuation to this stream of income depending on how stable they feel it is. If they feel that the stream of income is stable, they will be willing to pay more for it. If they feel that this stream of income is not only stable but is expected to grow in the future, they will be willing to pay even more for it because it's going to grow and the company becomes more valuable. So the next question in our mind is, how do we know how much those investors on the market are willing to pay to have an ownership in the company given the stream of earnings income? This can be very easily determined by market price. The market price tells us right now out there what investors are thinking. It tells us how much and how willing they are willing to pay for those earnings. A high price relative to earnings tells us that investors are very willing to pay for those earnings. A low price relative to the earnings tells us that investors are unwilling to pay for earnings and they require a discount. If investors assign a low price, we need to question whether or not the company is really worth such low prices. Maybe the investors are wrong and the price should actually be higher. If they are wrong, that's where we can actually make money. We can make money from their mistakes simply by buying the shares right now, wait for the prices to appreciate and sell for profit. That is how investing should truly be done. And that will bring us to the price earnings ratio. The price to earnings ratio is the very first ratio we are going to talk about. I'm sure many of you are familiar with this. Everyone talks about P ratio when they analyze stock. You can't really avoid using this ratio at all if you are looking to invest into the market. The price earnings ratio, often called the P ratio or price to earnings ratio, is a valuation ratio that calculates the market value of the stock relative to its earning by comparing the market price per share with the earnings per share. Price is something that you have to pay for the stock. So the next question is, what would you get in return? Your returns come in when the companies earn profit over time. So you compare the price against the earnings which are expected to come in over time in the future. Investors often use this ratio to evaluate what stock fair market price should be by predicting future earnings per share. Companies with higher future earnings are usually expected to issue higher dividends or have appreciating stock value in the future. Obviously, fair market value of a stock is based on more than just a predicted future earnings. Investors' speculation and demand also help increase a share price over time. The P ratio helps investors analyze how much they should be paying for a stock based on its current earnings. This is why the price to earnings ratio is often called a price multiple or earnings multiple. Investors use this ratio to decide what multiple of earnings is the share worth. It tells how many years the investors has to wait before they get back their returns. Of course, with the assumption that the current earnings of the company does not change.